rents went up pretty significantly. They ran up pretty significantly over the past couple of years. Well, over the past year, it's cooled down pretty significantly. So instead of going up 20%, now rents are down maybe 1 or 2%. On a holistic basis, if you look at like 36 months, rents are up 30, 35% in the market.
Welcome to the Cash Flow Chronicles. I'm your host, Jonny Catani, and the founder of Catani Capital Group. For the last 2 years, I've been studying alternative assets and now help solve the problem of creating passive cash flow for creators, influencers, and busy professionals by bringing you 5 episodes a week of easy to understand education in the world of passive investing. What's up, guys? Welcome to another episode of the Cash Flow Chronicles. I'm your host, Jonny Catani, and I am joined today by Bikran Sandhu. Bikran is the CEO, CFO, and co-founder of Rise48 Equity and Rise48 Communities. Bikran's main responsibility as COO includes overseeing underwriting, asset management, and investor relations for all assets. His main responsibility as CFO include overseeing accounting, finance, and treasury at Rise48 Equity and Rise48 Community. He resides in Scottsdale, Arizona with his wife, Alice. Bikran, welcome to the show.
Thank you, Joe. Really appreciate you having me on here.
Yeah, we're stoked to have you. Had Zach pretty early on. Obviously, you guys have done a lot even since then, which I'm looking forward to getting into. So we've gotten Zach's story of the founding of Rise and everything, but let's hear kind of your background, you know, what you were doing before and what's kind of led you to where you're at now.
Yeah, of course. So so my background, Jonathan, and thanks again for having me on the podcast. But my background is primarily to accounting and finance. So, I graduated from UC Irvine back in 2012 and joined Grant Thornton, which is one of the large public accounting firms. I joined as an auditor. My passion was always trying to kind of learn about how different companies operated and getting the inside scoop on, going everything from sales all the way through flushing through the cash all the way down to net income. So really glad, started with Grant Thornton did that for about a year and then moved into PwC, which is one of the largest public accounting firms. I did that for about 3.5 years, and throughout my career in public auditing, I understood how different companies operated in different industries. My main clients were in the technology space, which included and medical life sciences. So everything from startup companies all the way to mature companies that were traded on the New York Stock Exchange. And as an auditor, you really get an inside scoop of what's happening at the company from an operational perspective, like how all the different operations work. Sure, you can make a sale on one side, but there's 100 different processes for collecting that capital all the way down to making sure everyone's getting paid, you're paying your liabilities, collecting your assets, et cetera. So for, the first 4.5 years of my life, just kind of delved into the finances, and really didn't do a lot of forward-looking projections. And auditing, you're really kind of it's like you're sitting in a car seat, right? And you're or in a car, and you're looking kind of backwards through a rear view mirror. That's what an auditor does. They see everything that has happened and tries, the auditor makes sure that the company is effectively reporting everything completely and accurately to the stakeholders. Towards the end of my career, at PwC, I really wanted to kind of help management and be one of the driving forces as opposed to kind of looking at the rearview mirror. So I left PwC and joined C&M, which is a accounting and consulting firm. And at C&M, really kind of cut my teeth on helping companies buy other companies, sell divisions, help companies go public, kind of set up their processes. But did that for about 4 years, and throughout the entire career, and PwC and C&M, in addition to learning about finance, I was gaining a lot of experience in how operations work right at the company. And in 2017, 2018, we started, my then girlfriend, now wife, and I started to kind of get the itch for real estate. I had a couple real estate clients throughout my public auditing career, and it was interesting to kind of see how they functioned. Seeing how funds from operations worked, and how management gets compensated, how the investors get compensated, understanding the REIT structures. And I never really kind of pursued it, but I always thought, that's maybe something I want to do in the future. But in 2017, 2018, we had a little bit of free time. I ran some financial modeling for, our personal lives, and kind of quickly figured out, if you want to live the lifestyle that we want to achieve, we're going to have to not only rely on our W-2 income, but also some passive income. I looked into single family homes, multifamily, and kind of realized that it's not going to be enough to just do single family on the front end. I might be able to do, 5, 10, 15, 20 rental homes, but ultimately I'm going to have to go into multifamily. So instead of spending a decade learning about single family, why not just go directly into multifamily? Mainly because the business is completely different. It's some obviously skills are transferable, but most skills are brand new. So why not just jump into multifamily right away? So did that, joined a couple of mentorship groups, started going to meetups, just started connecting with people. And that's how I met Zach Happenstall and Robert Shefchik, who are the co-founders at Rise48 Equity, towards the tail end of 2018, beginning of 2019. And then, they at the time had a deal under contract. It was a 36 unit deal in Phoenix. It was a rough deal. It wasn't a 2022 build and brand new finishes and everything. It was, if you were an investor who was looking at it passively, you'd be like, yeah, I don't think so. That's not something I want to do. But what I wanted to do was, I wanted to get into the game. I wanted to make sure that, because I don't have any skill sets in multifamily, I'm not going to raise money for this deal. It's going to be my money. So, Zach, Robert, myself, and a partner that we had, we all put our money into the deal, our own money, and ran the deal with the property manager. But, we were all hands-on. So, the best way to kind of learn is through experience from my perspective. So when we bought that deal, the main thing that I did was I started looking at the accounting. I started looking at operations, how things worked, kind of like what I did at PwC and CNM, and really kind of got an understanding of how, money moves from one place to another. And, it was a great experience. I was at the time living in California. So everything was, for me, it was offsite. So I was just looking at what was happening on the financial side from a computer. But Zach and Robert, they were on site. They were managing contractors because we were going through our business plan of renovating units. And my main job was, hey, I'm going to develop investor reporting. I'm going to develop the lender reporting that we need to do and develop the accounting functions that we need to do to be able to scale this thing. So I just, spent hours understanding the background of how these companies run. And then, from there on, just started iterating. And now, we have we bought over 42 deals in the Phoenix and the Dallas MSAs, sold 11 deals. And, everything's been from that first starting point has been, hey, we're going to develop and then iterate.
I love that. That's quite the story, obviously, and speaks volumes to what you guys have been able to accomplish, right? All that experience from the firms you worked at and really taking those lessons and carrying them in. Before we kind of get to what's helped you guys really scale so quickly, we do have a lot of newer investors. What would be some accounting, kind of financial tips you could give to people who are just getting into it to help them, set up a good foundation if they ultimately want to scale as well?
Yeah, for sure. I think one of the biggest things is you need to have education, right, before you get into investing any money. It's hard-earned money that you've, earned over your lifetime, and before you give it to somebody else from an investment purpose, you should really know, what's happening on the background, right? So, from an accounting standpoint, I think the biggest thing is when you're looking at new investment summaries coming in, you want to get an understanding of what the quote unquote capital stack looks like. If you're buying a deal for say $45 million with $2 million of closing costs, so your total project cost is 47 million, how is that being financed, and where's the equity coming from? Where is the debt coming from? What are the terms for each of the different items? So really understanding how the sources and uses work for an investment is definitely critical, because you don't want to be, that last dollar in and the last dollar out, essentially, or the first dollar in and the last dollar out for some of these deals, which may or may not be heavy value add or heavier risk than normal. So understanding sources and uses of how much money is required and where is that money coming from is step one, and understanding who's in line first to get paid versus last to get paid on these deals. That's definitely very critical. And that's before even getting into asset management. It's a very basic side of the entire equation. And it's surprising to me how many investors don't really understand that and don't really understand where the money moves. So that you could get into trouble sometimes not knowing how your capital is being utilized for a deal itself. So I think that's very critical to start off with.
Love that. Yeah. Thank you so much for that insight. Very, very important to pay attention to all of that. Like you said, obviously right now, the big focus is debt, right? What does your debt look like? Take us back a little bit, right? You guys started to scale, you took off very quickly. What were some of those big keys, right? From the debt side and kind of the operation side and eventually obviously leading to vertical integration and everything you've done now.
Yeah, of course. So, the very first deals that we did, we essentially had a third-party property manager at the time that was doing all the property management. And we kind of quickly realized that, property managers, they're third-party fee-based companies that, they need to essentially bill back almost 95% of their expenses to stay profitable. So when we were doing our first few deals, we realized, like every single time we'd ask for something from a property perspective, you would see a charge for that request on the property's operations files. And a great example was marketing. So, we saw that the properties websites, for instance, were not set up correctly, which they should have been, which is part of the agreement. And we told the property manager about it, and they were basically saying, okay, well, we'll fix it for you. And it took about a couple months for them to fix things, which should have been done overnight, essentially. But then we saw two essentially recurring charges of about $500 a month for them doing their job, essentially. And it's not so much that, they're trying to nickel and dime you. They have to. But it was also that they unfortunately, they don't have a choice. They can't just offer these types of services without essentially incurring the cost. So we, from a very early standpoint, realized that property management, it's so much almost like a devil that you need to keep. But one day this is going to be in-house, that we're going to have to bring it in-house. The other aspect of this entire thing, from a value add strategy or the business plan, was we needed to go in and renovate the interior units and do the exterior renovations. Well, the property manager, they have their goals of keeping the units 100% occupied. So there was inherent conflict of interest there, where we need to accelerate the growth of the NOI through interior renovations, but the property manager wants to keep the units fully renovated so they can charge more fees off of that. So trying to get them to essentially go through the business plan and renovate faster was a hurdle in and of itself. So we were, kind of falling behind on business plans and making sure that we were getting renovations done appropriately. So, from a construction management point of view, we've always kept it in-house. But when we tried to kind of offload some of that to the property manager, we saw things start falling apart. We saw overages, we saw bills, and obviously the property manager is charging a construction management fee, which was also based on billing. So it was just kind of, it was a giant rolling ball. So quickly, we kind of realized that, okay, we're going to keep construction management in-house. And when the moment's right, we don't want to do it, but we're going to bring property management in-house, because we just need the control to be able to run these assets appropriately. So that was one of the very few, first lessons we learned. And from a capital stack perspective, the first few deals that we did, they were fixed rate loans, which, sounds great in today's environment, that, hey, if you had a chance to fix a rate of 3.5% 4 years ago, in hindsight's 2020, you should have done that no matter what. Well, the problem with fixed rate loans is that you have pretty hefty yield maintenance or prepayment penalties. So the first couple deals that we syndicated in August of 2019, we had fixed rate loans on there where the rate was 3.8%, and it was a $13 million loan. We sold that deal 2 years later and achieved around a 3.5 equity multiple for our investors. net of all the fees. One of the fees that we had to pay was a prepayment penalty to Freddie Mac, essentially, because we sold the deal 2 years into a 10-year arm or 10-year fixed rate loan. We had to pay a yield maintenance of about $3 million on a $13 million loan, just because, you know, we were essentially selling it way earlier than the period. So one of the things that we learned from that perspective was, okay, well, we're not buying deals that are built in, again, 2019, 2020, that are just going to be run for operations that we're going to hold for 10 years. We're buying value add deals where we're pushing NOI 20, 30, 40, 50% in the first couple of years. And if you put fixed rate debt on it, and that debt has hefty prepayment penalties, you're going to lock in your equity for a very significant amount of time before you can unlock it without paying a fee or without paying any significant penalties. So that's when we shifted essentially from doing fixed rate loans to floating rate loans, because floating rate loans, sure, the interest rate floats, but you do not have that heavy prepayment penalty on the front end. So if we, you know, renovate a deal and sell it within 18 to 24 months, we don't have to worry about a $3 million prepay penalties on the back end. And in order to kind of protect us from a risk perspective on these floating rate loans, is you buy interest rate caps. So every single floating rate loan that we've ever done, we've always bought interest rate caps. Those caps have always been for 3 years, so that when we do go in and renovate the asset and stabilize it within the first 36 months, by the time you're ready to essentially sell or refi the asset, we've pushed the NOI significantly where we can now refinance and put permanent debt on it if we don't want to sell it, or we can sell it and do a 1031 exchange to go to the next asset without having to worry about a prepayment penalty that we have to pay. So that's the type of debt structure we currently use. We do floating rate debt, but we buy, you know, interest rate caps on it to make sure our interest rate doesn't skyrocket. But, you know, that was lessons we kind of learned as we were buying deals, because everyone was preaching fixed rate debt for the longest time. And then as these value add deals started turning, people were like, okay, well, we literally cannot sell without incurring such a huge penalty. So we have to hold it longer. Well, then you miss a good time to sell in the market because now you have to hold the deal longer. So now we do floating rate debt, but we, you know, mitigate the risk of floating rate by buying caps, so that while we're renovating and increasing the value, we're not getting incurred additional penalties because we're paying higher interest rates on these deals.
Right. Awesome. I love that. That's really, really great insight. A lot to touch on. One thing I want to get to, kind of go back a little bit. You mentioned the construction management. One thing you guys did pretty early on as well is, you know, to really get your rinse and repeat model down, is you know, warehoused wholesale products, have everything there. That's not something you see a lot of operators doing. What was kind of the decision there, you know, to make that decision and do that?
Yeah, so, you know, early on, when we were underwriting various number of deals out there, right? You know, we basically had one business plan, which was it was consisting of 3 parts. One was take care of any deferred maintenance that was on the site. So if you have HVACs that are blown, we're gonna, you know, renovate and put in brand new HVACs. If the roofs are shot, we're gonna put in brand new roofs, etc. Take care of any deferred maintenance that tenants complain about. Step 2 was put in new amenities and update the rebranding and the signage of the property, so that when we do take care of all the deferred maintenance, you know, we have a brand new property effectively for the tenant to look at, and then we can get rid of the old reviews and put in new reviews based on how we're managing the asset. And then step 3 was interior unit renovations. Well, as we were kind of going through and you know, the first few deals that we did for the interior renovations, we would always come up with, like, you know, a different scope for a different underwriting. And we kind of realized that, okay, well, at the front end, it looks nice that you can put in a specific number for an interior renovations. Problem is, you're not going to know what the actual number is going to be until you have the deal under contract and you're doing due diligence. So instead of trying to figure out, okay, well, we're going to upgrade the countertops here to quartz countertops versus another deal, we're going to do resurface countertops versus another deal, we're going to do, you know, for mica countertops. We just said, okay, well, we're going to establish a standard renovation scope for our assets, and we're going to underwrite all the deals under this new renovation scope. And multifamily is a numbers game. You know, you're going to have hundreds of deals hit your desk. You can't sit there and underwrite every single deal to a full, you know, spend 40 hours underwriting every single deal and try to win every single one. It's not going to happen. So once we had our scope established and once we knew what our going in costs were from a CapEx side, we were able to underwrite deals a little bit more quicker and we were able to identify deals that really worked for us a little bit quicker. So once we had identified our scope, you know, we have preferred vendors that we utilize, for instance, for exterior painting. Every single deal, he essentially gives us a quote that matches what we have for our underwriting because we know what he's going to quote us. That he has a standard quoting process. He goes out to the deal, looks at it, lets us know, hey, I'm going to charge around $250,000 for the exterior paint for this. We underwrite $250,000. We don't get retraded on that because we do business with him very consistently and aggressively, so that we know what our numbers are going to be on the front end. On the interior renovations, we had established a high-end scope, and we work with a local vendor that, you know, buys materials from overseas, brings them into the warehouses in Phoenix and in Dallas, and they essentially house all the materials we need for our renovations. So everything from vinyl plank flooring all the way to paint and appliances. They deliver everything on site into the unit, and we know exactly what their scope's going to be. We know what their cost is going to be. So when we're underwriting a deal, and you know, we're going out to the broker and saying, "Hey, it's going to cost us X amount per unit to renovate and get our rents," that number is not a fake number. That's a real number, and the only way we can do it is we buy everything wholesale, and we have a supplier agreement with that vendor who can give us these products on a very low price as it compared to going out to HD Supply or Home Depot and trying to buy them off the shelf and then realizing, oh wait, we can't, for this deal we can't do quartz countertops, or for this unit they ran out of, you know, the white quartz, now to put, you know, brown quartz countertops, something like that. So it really helps us scale and renovate more and more units by buying everything in bulk and keeping it at, you know, at the vendor's warehouse, so that we can go ahead and deploy that whenever we need to, as opposed to trying to figure out by unit what we need across, you know, the 250 plus units we're renovating every month.
I love that. Such great insight and a true masterclass on really creating systems, like you said, that can scale, right? Really making it so that each process is so predictable that you can, you know, kind of, okay, we know what that is, right, in the underwriting. Because those who are underwriting, just getting into it, that's your biggest issue, right? Is I don't actually know, you know, you have your fixed costs, right? Some of the stuff, right? Property tax, you know what that's going to be, right? Some of those kind of predictable, rent growth, whatever. But, you know, the others, when you're doing the value add, can be so variable, especially over the last couple of years with everything that was happening with supply chain. You know, lumber one day might be this price and the next day it might be, you know, lower, it might even be higher. So by fixing those costs, that really works there. So one thing I want to get to is, so many people in this industry preach kind of, you know, the long-term hold, right? Fixed rate debt, like you guys mentioned. Take us through kind of the decision for some of these shorter term holds, right? You have some 14 and 16 and 18 month full cycle deals on there. What were kind of the decision-making process for that?
Yeah, I think the biggest decision-making process for our end is like, you know, we're not greedy in a sense that we want to get the highest equity multiple and the longest hold period for investors. Sure, the numbers look great. You know, if you hold it for 5 years and say, instead of hitting a 2x in 5 years, I hit a 5x in 5 years. But the problem is, you know, you run the risk of holding the deal even longer and longer for just that extra juice. So we've internally kind of established an expectation that if we can get to around 25 to 30% average annual return for our investors in at least 2 years, or, you know, in 3-year periods, we're going to go ahead and exit the asset. It doesn't make sense for us to try to juice the deal even more and more, you know, because we know the type of deals that we run, we know how long it takes to stabilize, and we know the amount of operational risk that's involved there. So we understand that, hey, if the timing is right, if the market's right, we can exit the deal in 24 months and get, say, a 1.7, 1.8 equity multiple for our investors, then we're going to go ahead and exit the deal. But we also understand that when we do exit, you know, there are tax consequences. So investors do get hit with recapture tax and capital gains tax, as is applicable to them. So what we try to do is, we'll try to identify 1031 exchanges where we can identify a replacement asset where investors can take the money that they just earned from selling this relinquished asset and move it to this replacement asset, and hopefully defer some of their taxes that they would have incurred if it was just a straight sale. So I think the biggest thing that we worry about is once we have this equity built out in a deal that's been, say semi-stable to more stable, we want to make sure that we can unlock that equity for our investors. So we kind of shy away from doing fixed rate debt and then putting a supplemental on there and then holding the deal longer. Because, the other aspect of putting a supplemental loan on there is you have higher interest payments that you have to pay because of supplemental, which is also a higher interest rate in and of itself. And then you're not unlocking 100% of the equity. So if you're going in LTV at the deal, say it was 75% when you first bought it. Now with the supplemental, you can get up to like say 70%. Well, 30% of your equity is still locked. You can't access that anymore because you have a supplemental on there now. And with Freddie or Fannie, I think you can only have one or two supplementals. So if you bought the deal, put a supplemental on after 2 years, and put another supplemental on after another 2 years, then you basically, with a fixed rate debt with a supplemental or two on top of that, you cannot essentially refinance without incurring a significant prepay penalty now. So you're just locked into the deal. And then most of the deals that I see from Freddie perspective or Fannie, they have interest only periods for, say 5 of the 10 years. And then after the 5th year, it starts amortizing. Well, now after 5 years, now you're paying amortized monthly payments, principal and interest. Your cash flow is going down even further, and you have locked up equity. So from our perspective, it's a no-brainer to sell the deal after you've hit a certain return for your investors, net of all your fees. And then once you've unlocked that equity, find a replacement asset where they can help investors potentially defer their capital gains or the depreciation recapture, so they don't get incurred with additional penalties because you sold too early on the deal.
I love that. Yeah, that's really, really great insight and a good explanation, right, for people to understand, because, you see those quick turnarounds, right? And you kind of wonder, and then obviously you mentioned the tax side of things as well. One thing I want to touch on is, Arizona is obviously still a very hot market, no pun intended. Things are starting to ease up, right? Sort of normalize, right? Yeah. And it went up so high that, you kind of see these big corrections, right? And it feels like, oh, they're tumbling back down. But in reality, it's like, it's just coming back. What is communication like with investors to help them understand that, Arizona still has the strong economics and infrastructure, to support the growth?
Yeah, no, as you said, Jonathan. So basically what we have is, we, in the past couple of years, we had rent growth around 20% per year for the Phoenix MSA. So, rents went up pretty significantly. They ran up pretty significantly over the past couple of years. Well, over the past year, it's cooled down pretty significantly. So instead of going up 20%, now rents are down maybe 1 or 2%. On a holistic basis, if you look at like 36 months, rents are up 35% in the market. You compare that to other markets which are also slowing down, like say Dallas or the other southeast markets. You're seeing holistically rents are around 30 to 40% higher than they were 3-4 years ago. It's just that the problem with Phoenix is that it shot up so significantly, and now it's coming down and cooling down very significantly, that investors get spooked that they think the sky is falling. But you also have to understand that the basic premise of multifamily investing is you want to put your money where you have job growth and population growth. Phoenix and Maricopa were ranked, Maricopa County was essentially ranked #1 in the nation for most move-ins in 2021 and now and again in 2022. And, based on the population that's moving here, even this year, I'd be surprised if Phoenix or Maricopa County is not in the top 5 next year as well. So we have population growth. That means we have the demand for the units in Phoenix. Pricing for single family homes has still not come down. In Phoenix itself, you see a lot of doom and gloom about, hey, the bubble's just about to burst, and pricing is going to be 50% less in the next 3 to 6 months. Just hold on, just for a little bit longer. Well, interest rates shot up essentially all of last year, and we're already in May of 2023. Interest rates are still going up a little bit, but they were around 6% for single family homes, essentially in Q3 of last year, at the Q3, Q4 of last year. So I'm still, what's going through the mindset of single family homeowners is I've locked in a rate of 2.5%, 3%, 2, 3 years ago. Why would I sell my house? I'm going to stay in this house for a longer period of time. It's not an ARM loan, or it's not an adjustable rate mortgage. So they're going to stay in their house longer and longer until interest rates come down. And what that causes is you have a shortage of supply of single family homes, meaning that the price stays high. You're going to have a little bit cooling here and there because you're going to have some people that need to move. So you're going to see pricing come down a little bit. But as long as interest rates stay high, majority of the homeowners are not going to sell and get into a higher rate mortgage by buying a different home. They're going to stay in their current home and kind of ride out the wave. Well, what that does is it prohibits renters from essentially buying homes in the state as well. So you have more and more renters in Phoenix itself. So you have supply of people growing. You have less units available for single family homes. So in and of itself, it's kind of making the renter base kind of grow in Phoenix. And you'll see the slowdown, the growth come down because of affordability ceilings you're hitting. But you're not going to see just like, a drop all the way down to like a 20% decline in rent growth, because you don't have enough supply here for all the renters that are coming out. It's plain and simple on the economic side.
Yeah. And that's pretty true across the board for most your top markets, right? Dallas, obviously, kind of same thing. I'm here in Salt Lake City. We're experiencing the exact same thing. So, not really, a sky is falling '08 kind of a thing, right? We're in a very, very different market, obviously other issues economically. So as we kind of wind down here, what does the next kind of 12, 24 months look like for Rise as you guys continue to grow?
Yeah, I think the biggest thing that we're focused on is operations. Renovating all the units that you have. A lot of the syndicators going into these deals, they're essentially tout a very heavy value add strategy where they're spending $5,000 to $10,000 per unit and renovating that asset or that specific unit, but they're not really following up on it because they're just waiting for the market to get to that point. Well, we were benefactors of the market going up as well when we bought deals in 21 and 22. So we didn't renovate at a significant pace that we are now. We would renovate maybe 20 to 30% of the asset by the time the first year was done. And at that time, it was a good time to sell. So we sold the deal. We didn't hold it longer. Well, now we don't think we don't think we'll sell any deals this year. I think probably next year we'll start offloading some assets. But right now, the name of the game is renovate your units so you can increase NOI across the board. So that's what we're doing across our entire portfolio is we're ramping up renovations, getting these properties up in NOI, up in value so that we can, if we can't sell it in the, by the time the 36 months is up for the deals, at least we can refinance and hold it for another 6 to 12 months before we decide to sell the deal. And, it's great to have a team here, full of our operations management, asset management, our financial planning and analysis teams to make sure that we're full on board in renovating. Because without them, this thing would essentially collapse because there's a lot of analytics that are involved with all this. So the two key strategies that we're focused on is renovating our units and going after deals that are a good basis in Phoenix and in Dallas, because we know there's the buyer pools kind of shifted away a little bit just because everyone's a little spooked. We think now's the time to strike to pick up some good assets at a low basis. So that's what we're doing. We're going after deals that are somewhat distressed. If the seller bought it in 21, 22, their interest rate caps are expiring, and they want to sell it, well, we'll go in and buy the deal if it makes sense for us, but we're not going to overpay for anything. We're not going to underwrite, a 10% rent growth on a deal just to make it work. We've underwritten over like 140 deals in Dallas. I think 3 have worked, or 4 have worked, and those are the ones we pursued. But yeah, right now it's, operationally renovate units, and on the transaction side, buy good deals at a good basis is what we're going to do over the next 12 to 24 months.
I love it. such a solid game plan, right? And obviously, speaks volume to what you guys have been able to accomplish and will continue to accomplish by taking, your portfolio looks aggressive, and you've obviously been aggressive, but you did it when it was the right time to be. You're using so much analytics and constantly, looking at the important factors to determine whether or not it's right time to be aggressive. And obviously now it's time to really execute the full business plan. And you've recognized that, which is what's getting people in trouble, is the opposite, where they just, all gas, no brakes, weren't analyzing anything. Like you said, rent camp's expiring. So I love it. Awesome. Well, let's go ahead and wind down here. We'll jump to the final five. First question, best advice you've gotten from a mentor?
Yeah, I would say the best advice is, in real estate, you're not going to get rich quickly, but you're going to get rich for sure. I forget who said it first, but the first time I heard it was at one of these mentorship groups. And that's what people need to understand as well, is we'd love to get a 2X in 12 months every single time we buy a deal, but it's not going to happen every single time. So, but these are hard assets, that we've underwritten very thoroughly, and they're gonna be profitable at the end of the day. It just takes time to get there.
Absolutely. Yep. Get rich slow scheme, as they call it.
Yep.
What is it about your career that makes you feel like you're fulfilling your why?
Yeah, I think, building out a company that is run efficiently and, hires the right employees and hires the right mindset employees to help grow the investor wealth as well as the renters in our communities is definitely very key for me. I want to make sure that, we're not slumlords. We don't go in and buy 50s assets and don't take care of the property. We want to make sure we do right by the tenant. And by doing that, we're doing right by our employees who feel good about the properties that we acquire. And we do right by our investors who, they're investing in a cause that's good for the overall environment.
I love it. That's awesome. Favorite non-real estate or investment related book?
Yeah, it's called Find Your Why by Simon Sinek. It's a great book. It really kind of helped me turn around my mindset of how I look at what I do, because I always used to ask, what is it that I want to do instead of why is it that I want to do something? So starting to understand why I want to do something has helped me kind of shift my career in the right perspective.
I love it. Yeah, that's on the list. We've had that a few times, so I'll definitely have to read it. If you could have any superpower, what would it be?
The ability to not sleep.
Gosh, you and Zach, you guys have that in common. I think that was his exact answer too.
No, there's some days like you just want to like work more and more just because you just enjoy it, right? Sometimes it's like, okay, well, your body's getting tired and it's like, all right, now I have to kind of cut it off at some point. Like yesterday we were here till like at 8 or 9 p.m. and just like working on some finance stuff, and we were like, oh crap, it's time to go home. You had to go work out, I had to go sleep, and it's like, all right, fine. Let's go.
Yeah, no, I feel that for sure. And like you said, when you're passionate about it and you love it, it just doesn't feel like work, right? You want to keep doing it.
Yep.
Cool. Last one. What's the best way for people to get a hold of you and learn more?
Yeah, I think the best way is to go on our website, rise48equity.com, and then you can go to the invest tab and then set up a call with Zach, Robert, myself. But you can also reach me via email, my name at rise48equity.com, Bikran at rise48equity.com. That's the best ways to reach me. And then, if you're interested in learning more about Rise 48 or, my background or investing in general, or even investing with us, feel free to set up a call. We can add you to our investor list, and then we can go from there.
Awesome. We'll link that and then show notes, make it super easy. Bikran, thank you so much for your time. This is absolutely amazing.
Thanks so much for having me, Jonathan. I appreciate it.
Absolutely. Thank you again for tuning in. Who do you know that wants more cash flow? Share this episode with them so you can grow your cash flow together. If you enjoyed the show, make sure you're subscribed on your platform of choice so you never miss a new episode. Go to KataniCapitalGroup.com to learn more.